When traders get scared, option prices can explode even if the stock barely moves. The reason is the VIX. Why this works now. VIX options volume hit a record 858,000 average daily contracts in Q3 2025, showing how central volatility trading has become. People often call the VIX the fear index, but that's actually a bit misleading. The VIX doesn't literally measure fear. It measures expected volatility in the S&P 500 over the next 30 days. In simple terms, it's based on options prices. When investors expect bigger price swings, up or down, they're willing to pay more for options, and that pushes the VIX higher. When markets are calm and expectations are stable, the VIX tends to stay low. So yes, the VIX often rises during times of uncertainty or market stress, which is why people associate it with fear. But technically, it's not tracking emotions, it's tracking how much movement traders expect in the market. Think of it less like a fear gauge and more like a turbulence forecast for stocks. High VIX means rough skies ahead, while low VIX suggests a smoother ride. Implied volatility, or IV, plays a big role in how options are priced. At a basic level, IV reflects how much the market expects a stock to move, and that expectation directly affects option premiums. When implied volatility is high, it means traders are expecting bigger price swings. Because of that uncertainty, options become more expensive, both calls and puts, since there's a greater chance they could end up profitable. On the other hand, when implied volatility is low, the market expects smaller moves. With less potential for big gains, options tend to be cheaper. So, a simple way to think about it is higher IV equals higher premiums, and lower IV equals lower premiums. It's not about direction, it's about how big the move might be. A simple way to understand implied volatility is to look at big events like earnings reports, Fed announcements, CPI data, or even geopolitical shocks. Before these events, there's a lot of uncertainty. Traders don't know what's going to happen, but they expect a big move. Because of that, implied volatility rises and option premiums expand. In other words, options get more expensive leading up to the event. Then the event happens. The uncertainty is resolved. Even if the stock moves, the unknown is gone. As a result, implied volatility drops often sharply. This is what traders call volatility crush. Option premiums shrink after the event, sometimes very quickly. So the key idea is premiums expand before the event due to uncertainty, and they often get crushed after the event once that uncertainty disappears. Many beginners think trading options is just about predicting direction, whether a stock is going up or down. But in reality, you're making more than one bet. You're also betting on volatility, how much the stock will move, and timing, how fast that move happens. For example, you could correctly guess that a stock will go up, but if it doesn't move enough, or it takes too long, your option can still lose value. That's because factors like implied volatility and time decay are constantly affecting the price. So even if your direction is right, you might still be wrong on volatility or timing, and that can cost you. The key takeaway is this: options trading isn't just about where the market goes, but how fast it gets there and how much it moves along the way. The VIX won't tell you direction, but it will tell you when options are getting more expensive. Thanks for joining me. Don't forget to hit like and subscribe for more options, trading tools, and tips. Want to follow up on implied volatility crush? Tell me below.